Good morning, traders and investors. So I'm looking at launching a new trade here in optionstrat. It'll be the first one I'm doing, excuse me, in futures, using the new futures capability. So I'm going to do this in the ESZ. Now, the ES, of course, is the futures contract for the S&P 500. And if we come in our field here and we type ES, it automatically will show you ES futures. And then you have to select the contract. It's really nice that it shows you the different contracts here. I'm going to trade the December contract. The trade I'm going to do is actually a calendar. Now, calendars are a little bit unusual in how they act, and I shared a little bit about these in the preview of the new features of optionstrat. But what I want to do here specifically, I'm going to do a fairly tight dated calendar. So I'm going to do my front period is going to expire on November 17th, and then I'm going to bring my back period in much closer to go November 20th. So this is essentially a 3-day calendar, or an over-the-weekend calendar, if you will, because the 17th is a Friday and 11/20 is the following Monday. So you notice that when I select a tighter time frame here, the calendar is less expensive. I'm looking at this calendar basically having a max loss in the $200 range. If I make this out further in time, let me bring it out quite a bit further in time, you'll see that the max loss grows considerably. Well, the reason for that is, of course, we are selling a front strike, and we're going to sell it at, in this case, about $87. And then we're buying a back strike, and the further out you go in time, the more that back strike is going to cost. So if we come in here to a much tighter back time frame, we're going to see that, rather than $98, it's $90. Now, I want you to look at one other thing here as well, because many people think that calendars are a positive Vega trade, meaning if you get into a calendar, many people will enter them in low volatility, thinking that if you get into them in low volatility and volatility increases, that calendar is going to become more valuable. And the reason they think this is on most programs, when you come in and you slide this slider, you can see that this shows that this thing moves into profitability fairly quickly. Now, the problem with that theory is that's making the assumption, which is what many programs do. It's making the assumption that both the front and the back increase in volatility at the same rate. Historically, that's not the norm. Normally, your front period will peak or will grow in volatility first. So volatility kind of comes into the market like a wave. So it's awesome that optionstrat has included this particular capability to come in here and say, I want to see what happens if just my front period strike increases in value. Now remember, we're short those front strikes. An increase in value is not going to be good on those, okay? A decrease volatility. An increase in volatility will not be good. A decrease in volatility in that front period strike will be good for us. So if that is the case, it generally, contrary to popular belief, can make more sense to put on a calendar in a higher volatility environment, particularly when the front period might have a little higher volatility than the back period. So let me just come and put this back to average IV, and now let's just look at the volatility of our two options. So our front period right now has a volatility of 20.3%. Our back period has a volatility of 19.9. This is something known as backwardation. In backwardation, you have a little higher volatility in that front period than the back period. that can create a favorable situation to enter a calendar. It doesn't mean that the calendar is going to be an automatic winner by any stretch of the imagination, but what it does do is it gives you a little better reward to risk ratio when that is happening. The other thing that can happen here is that if that front period has a little higher volatility and volatility starts to drop out of this trade, it will drop out of the trade a little bit faster. Normally speaking, again, it comes in like a wave into the market where it hits the front dated options first and then goes to the back dated, and then vice versa the other way. It will, when volatility reverses, it's going to usually reverse in this front period first as well. So if we put that on in a higher volatility environment, like we are right now, by the way, let me just spin over to, this is the VIX. This is a chart of volatility. We can see that volatility right now is spiking. It's breaking to new highs here. So, and again, volatility tends to be a little higher in the shorter dated options in this type of situation. And again, that's what creates the backwardation. So I'm going to go ahead and I'm going to save this trade, and we're going to call that a calendar put spread, and we're going to say entered on 10/20/23 in higher IV. Now, ideally, I don't want to carry these things too close to expiration. I would love to get out of this well before expiration. So this is about 30 days out. I'm going to look to hopefully exit this in about 2 weeks maybe. But I've also done this very small. So if I want to come in and add to this, I can come in and add to this trade as well. I may need to add another tent if the market moves up or down on me, or possibly turn this calendar maybe into a diagonal possibly. So I'm just going to go ahead, hit the save button. I'm going to copy the link, and I'm going to share the link in the notes down below. Everybody, please, give me any comments, like, subscribe, etc. And one last thing here, the buckle up Buttercup trade. I need to wrap that whole thing up here. So unfortunately, it got so crazy going into expiration. The market just ripped up and down those couple days around expiration. I ended up having to kind of day trade that stupid thing, and there were so many adjustments. But I do want to show you just kind of a little sheet I put together for the the follow-up to it. So it had 24 adjustments. I have never adjusted a trade so many times in my life. This trade opened on September 13th and finally closed on October 19th. I'm going to look at a chart here in just a second. At one point, this trade was down almost $16,000. I was able to bring it back to where it was down about $6,000 after I factor in all my commissions. This is probably the largest loser I've had in quite some time. Again, there were so many adjustments in there that people ask when I close a trade. I don't usually close a trade when it necessarily goes against me, but usually after 3, 4, 5 adjustments, when I'm chasing the trade up and down, that is typically when I might go ahead and pull the plug, because I do not like to get into a day trading scenario. And yesterday, when I was in that day trading mode, our market moved rather significantly. Early on in the day, this trade was only down about $3,400, which would have been a great time to close it. But I put an order out there to close it. I had other meetings I went to. Then I come back and the thing, the market had tanked on us. And created a much more sizable loss than it was when I had left. So shame on me for walking away. I mean, if I'm going to accept the day trading that had to take place on this, I should have been there for it, but I wasn't able to change this other specific meeting. So I do want to just quickly take a look too at, what our market was like at this time, September 13th to October 19th. So let's just come back here and take a look here at SPX, And we can enlarge this a little bit here. So we look at SPX. This thing opened here on the 13th. So our market went down, so this was about 45.20 down to about 42.20. So that's a 300-point drop this thing had. And so obviously I had to adjust and chase that. And then when I get it finally adjusted and set up to where it'll probably do well in a bearish market, you know, then the thing rips back up, and then I get it adjusted, you know, to where it's somewhat neutral, looking like it might stabilize around this point, and then it tanked again. And then the final day, which was yesterday here, again at the open, right around here in the 43.30 range, the trade was looking really good. It was only down again around $2,800 to $3,000. I'm thinking, geez, I might be able to get a total scratch out of this, or maybe even a hair of profit. And that's when I went off to my meeting. When I came back, the market had done this. And of course, anytime you have a trade that is an expiration day, high gamma, any movement in the market is going to impact that trade significantly if you're near the money with your strikes, which of course this was. And as a result, by the time I got back and the market was down here, my loss had increased, and I just pulled the plug on it. So buckle up, Buttercup. Did not work out well. But again, that kind of goes with the territory. And I would say about 80% of the time, those butterfly trades are winning trades for me. And that one wasn't a good one. Had I picked any other trade that I put on around that same time, all the rest of those are winners at this point. This particular one just went everywhere on us. So anyhow, I'm sorry I wasn't able to track everything that I did in those last couple days, but I'm not trying to share day trading, and I'm not trying to help students understand day trading. So bottom line is it involved a bunch of things that I should have been watching literally on a minute-by-minute basis, which is not the way I like to trade at this point. So going back to the trade just entered, I mean, this is a good type of trade that I think will be a good educational one that should not require a crazy amount of adjusting. Usually what I do on these is I look to pull these things off when they get up about 10-15%, somewhere in that general range, which these things can sometimes do fairly quickly, and a little bit of reduction in volatility. So that's it for now. Thanks so much, everyone. And again, please like, subscribe, give me any thoughts or comments. I greatly appreciate it. And that's it for now. Take care.